Hi, this is Tony Sagami for Uncommon Wisdom Daily. There was a flurry of economic news out of China last week. So today, I'm going to connect the dots and tell you what those reports mean to us as investors. The biggest headline was a cut in the reserve requirement for Chinese banks, the first such move in 3 years. The People's Bank of China cut the amount that money lenders must hold in reserves by 0.5 percentage point or 50 basis points. That may sound like a lot, but it's actually a cut from 19.5% to 19%. So the effect of the move is really more psychological than practical. However, it is a reversal from China's previous policy of monetary tightening. So in that sense, it tells me that the country's leaders are afraid that the Chinese economy is slowing down too much. They would not have reduced the reserve requirement unless they were seeing some pretty big warning signs. One of these warning signs is a slowdown in the Chinese manufacturing sector. HSBC Bank's widely watched Purchasing Managers Index fell to a 32-month low last month and is now under 50, which indicates contraction. In other words, China's manufacturers and exporters are feeling the pinch from a slowdown in the Eurozone economy. Additionally, Chinese real estate sector is hurting as well. October housing transactions declined by 25%, and prices fell in 33 out of China's 70 largest cities. The weak demand caused China Vanke, which is the country's largest developer, to warn that it may have to lower prices. And according to Credit Suisse, around 80% of Chinese developers are behind on their payments to the banks. Heck, even the vice premier of China admitted that Chinese real estate market is at a critical stage. Meanwhile, Chinese corporate profit growth is also slowing. Profits at China's industrial companies grew by 12.5% in October. That's less than half the 27% pace for the first 9 months of the year. All these warning signs tell me that the Chinese government is ready to take serious action to keep its economy growing. But unlike the United States and Europe, China has a huge hoard of cash reserves that it can use to stimulate its economy. $3.4 trillion. In other words, China doesn't have to sell any bonds, it doesn't have to print a bunch of money, and it doesn't have to go into debt to finance a stimulus program. It has the money. Plus, as a command economy, China's leaders can do whatever they want without worrying about building bipartisan support or worrying about what the media will say. What China's leaders want, they get. And if they want to stimulate their economy by spending a mountain of money, they can do so tomorrow and do so very effectively. That's one of the reasons I'm growing more optimistic about China. Another is the fact that the Shanghai index is down by about 20% this year, and Chinese stocks are now selling for just a little more than 11 times earnings. Now, I'm always looking for great companies at cheap valuations, and the recent dip in the Chinese stock market seems like a great opportunity to increase my Asian exposure. I'm telling my Asia Stock Alert subscribers which companies to invest in and when to do it. For Uncommon Wisdom Daily, I'm Tony Sagami. Thanks for watching.